Hey everyone, and welcome back. Today's video is stock market Q&A for the month of August 2020. So as always, I'm going to be selecting a couple of questions from my audience and answering them on today's video. So if you're wondering how you can have a question in next month's video, the first thing that you need to do is you need to be subscribed. So go below this video and hit that red subscribe button. And then essentially a couple of hours before I make the video, I go onto the community board on my channel and I post asking for questions from you guys. So if you're subscribed, you will see that post in your subscription box. But without further ado, let's jump straight into the first question. So the first question that we have for today is from Kevin. Since you live in Australia, wouldn't you be more knowledgeable about Australian companies than US companies? Also, Australia ranks higher than the US in terms of economic freedom, which suggests that their stock market should perform better. So my question is, why do you choose to invest more in US companies than Australian companies? Yeah, so in terms of the part of your question around wouldn't I understand Australian companies better than US companies? Well, when we're talking about the largest in either the US and Australia, I actually understand US companies more because all of the products and services that I use on a daily basis, most of them are coming from US companies. So Apple products or using Facebook or using YouTube, for example, as my business. All of these things and pretty much every other consumer product that I use on a daily basis or service that I use is from a US company. So in that way, I am a consumer to more US products and services than Australian products and services. So in that way, I prefer to invest in American businesses where I can still find really strong, great businesses that are selling products and services that I have a little bit more of a closer relationship to personally. I do occasionally invest in Australian businesses, and just because most products and services that I use on a daily basis are American, that doesn't mean that I never invest in Australian companies. It's just the case that the biggest companies in Australia, if you look at the top 50, for example, they're mostly mining companies, insurance companies, or financial institutions. And none of those are areas that I'm interested in. I'm much more interested in consumer products and services or restaurant chains, which most of the big ones come out of the US as well. So it just so happens that the areas that I'm interested in and the products and services that I use on a daily basis are usually coming from US companies, and that's why I focus mostly on looking for businesses in the US market. In terms of the economic freedom comment, I really don't have any sort of broad predictions to make about whether Australia will do better than the US or even whether having a slightly freer market would drive higher economic results. That's not necessarily always the case, although clearly a market that is mostly free allows businesses to flourish and grow and be more productive over time. But when I'm investing on an individual business basis. So that's not something that really comes into consideration. The next question that we've got here is how to minimize exchange rate risk when investing in overseas shares. Yeah, so exchange rate risk, the risk between the exchange rate between foreign currencies, I think that that's something that's really unpredictable. It's certainly important and impacts your overall return. So if you're buying shares, if you're Australian and you're buying shares in the US, the exchange rate between the US dollar and the Australian dollar will impact your overall return. But I think that it's something that's quite unpredictable. So as a result, the only thing that I really do in order to hedge or protect myself against that exchange is that I always hold foreign currencies that I want to invest in. So obviously, I have Australian dollars because I live in Australia and some of my business revenue comes in Australian dollars. And then I will put money in US dollars and some of my business revenue comes in US dollars anyway. So I'll have a balance between Australian and US dollars. And that basically means that if I want to invest in a US business, I'm not at the mercy of exchanging at a bad exchange rate because I already have money in US dollars ready. And I also have money, of course, in Australian dollars if I want to invest in an Australian business. So that's really the only hedging that I do. The next question that we've got here is, hey mate, thoughts on dividend investing? Yeah, so I mean, I think if you're going to be looking at businesses that have really high dividends or at the least pay most of their earnings out as a dividend, I think that only really makes sense if you are looking to use your stock market investments as an income stream for you. And first of all, I don't think that you should be using your stock market investments as an income stream unless you've already spent a few decades building up a huge portfolio and you're now drawing that down as a part of your retirement. So if that's the case, then maybe leaning into businesses that have a really strong track record. They don't have many opportunities to grow, but they just pay out all of their cash flows or most of their cash flows out as a dividend. That might be a smart option, but when you're young and when you have a number of decades in front of you or a number of years in front of you to invest, I am much more interested in businesses that have opportunities within the business to reinvest and grow those future cash flows. So I'm looking for businesses that sometimes they pay a portion of a dividend, sometimes they pay no dividends, but at the very least, they have opportunities available to them to reinvest their cash flows and grow them over time. And then maybe in 10, 15 years down the road, that business has less opportunities to invest and now they're paying out more as a dividend. Those are the kinds of businesses that I'm typically focused on. And one last thing to sort of add to that, ultimately, if you have a number of years in front of you, if you have a decade or 2 decades in front of you and you have time for the market to realize the value of the cash flows that it's producing, so you have time for the market to correct an undervalued business or to go up to reflect the real value of that business, then it really doesn't matter what form, it really doesn't matter how much they're reinvesting, and it really doesn't matter how much they're paying out as a dividend. What ultimately matters is the overall amount of cash that business is producing overall in terms of the money they keep in the business and then the money that they pay out as a dividend. In the short term, the market might not realize the value of the money that business is keeping in the business. So if you need to get cash flows from your investment, then you would want businesses that are paying a higher dividend. But if you have time to wait, then it makes sense just to focus on the overall amount of cash that business can deliver to you. The next question that we've got here is, I like your videos and Brandon's, thank you very much. But I have a couple of questions when it comes to value investing. Your strategy is based on waiting, that is waiting for an event, as Town is used to say. But what about what about the inflation that keeps eating the cash while we are waiting? Yeah, so I want to be clear. I'm not waiting for anything, right? I have most of my money invested in the stock market, in a number of businesses. And if there is substantial inflation, it's likely that those businesses will do quite well in terms of protecting me against that inflation. And the way to think about that is, if there's inflation, let's say that causes a loaf of bread to go from $1 to $1.50, then as a consumer, you have to pay more for that loaf of bread. But as a business that's producing bread, you're now generating more revenue. So holding businesses typically as an overall category, investing in stocks as an overall category, is going to be a protection against inflation. And that's exactly why you would never want to be 100% in cash. But you would also never want to be 100% in the stock market in the event, especially if it's an expensive stock market like I think it is right now, because there's a good chance that stock prices will go down to reflect their true value. And in those cases, you want to have cash around in order to invest in those businesses at better prices. The other thing to mention is that some people will have the strategy of being completely out of the market or mostly out of the market and just waiting for some kind of global economic downturn where the stock market gets pulled down 50, 60%, and then their plan is to invest substantially. And I think that is a big mistake. The way that you should be thinking about it is, with the businesses that you deeply understand, you should have a price in which you're willing to pay. And most of the time, the business isn't going to be at that price, because most of the time, if business is going well, then people are bidding up those stock prices. But you don't necessarily need to wait for a global economic problem or even a national economic problem for you to be able to buy that stock cheaply. Every year, every 2 years, there is at least 1 or 2 industries that are going through some kind of problem themselves. So while the rest of the economy is going really, really well and really, really strong, there could be 1 industry or 2 industries that is struggling or are at the end of their cycle. Or it could even be the case that an individual business is going through some kind of problem and its stock price on its own is going down while the rest of the industry and the rest of the stock market is doing really well. So I guess to kind of summarize my answer to this question, you started your question by saying your strategy, or my strategy that is based on waiting. But a better way to look at it is I have investments in the stock market. My strategy is to wait to add substantially more to those investments. So I always want to have investments in the market, but I'm just not going to be using a lot of my cash to buy those businesses when they're overvalued. I want to wait until something happens. And there will be something that happens usually once every 1 year or every 2 years where there is an event in the industry, in the individual business, or in the overall economy that will give me the opportunity to go heavy into a really, really great business that I've spent a lot of time analyzing. The second part of this person's question was, suppose one had been investing for a long time, such as 30 years, and when he or she comes to retirement, the market was down terribly, such as in 2009. What will she or he do then? He is just screwed up and his investment has gone all wrong. Well, the thing is, when you're ready to retire, it's not as if your plan is to sell, or it shouldn't be. Your plan shouldn't be just to sell your entire portfolio and be in cash and just live off that cash. Your plan should be that you should have built a retirement portfolio that you can draw down partially while leaving most of it to continue to compound. So if you've built a really big retirement portfolio, you might not even need to draw down and sell any of your shares because they might be paying enough dividends in order for you to live off. But in most cases, I think partially you'll get some from the dividends, and then you'll also sell a portion of your investment. So if you had been building your retirement fund or your retirement wealth for 30 years and then you wanted to retire in 2009, well, you would still be receiving some portion of dividends from that portfolio, even though they're in a recession. If you had to draw down and sell some of those investments, that's unfortunate that you would have to sell them substantially less than 6 months ago or a year ago. But most of your portfolio should be staying in the market. And it will, as we saw, it went back up. When businesses returned to being strong, when the economy improved, business prices went back up, the portfolio would have gone back up. So that's kind of that answer. I hope that kind of answered that question. Oh, and just one more thing I wanted to add to that question is that if you were planning to retire in less than 5 years, for example, then I would not be 100% in the stock market. That's just me personally. I would be recognizing that anything can happen in a 5-year period, and the market can be down severely over a 5-year period. So if I'm planning on retiring and I need to access some of that money, I would be moving some of that into some more stable and consistent investments, whether that's some bonds or something like that, where I can still get some kind of return, but at least I know it's a fixed return, right? Fixed income. I know what I'm getting out of it, whether that means having more cash or whether that means putting money into assets that provide a higher cash flow. So property investments or something like that. But yeah, that's a very sort of challenging question to answer in just a couple of minutes, but I hope I was able to answer that for you. And the final question that we had time for today is, hi Hamish, could you explain how to consider debt in the discounted cash flow calculation? Yeah, so the first thing to say is we should break up debt into interest payments and principal. So the actual principal amount that they need to pay down, the loan amount, versus the interest payments on that debt. So in terms of the interest payments, that is already taken into account in the cash flow for owners figure. So the interest payments, that's an operating cash flow. It's a cash flow that's considered a part of the normal operations of the business. So when we have our cash flow for owners figure, the interest payments have already been subtracted. But what has not been taken into account is the principal amount of debt. How much debt do they need? Do they actually owe? Do they still owe? Do they still need to pay down? And really the most accurate way that you can deal with this is to, when you've come up with a buy price, so when you've got a buy price from the discounted cash flow, instead of comparing that buy price to the market capitalization of the business, so in other words, the price of the entire business, you should be comparing the buy price to the enterprise value of that business overall. The enterprise value is simply the market capitalization plus debts minus cash that the business has. So in other words, if we think of the market cap as the price for the whole business, since when you're buying into that business, the business has debts that need to be paid, you should be plussing those debts to the price that you're paying for the business, because you're also assuming those debts. Now, obviously, as an individual shareholder, you're not assuming those debts, but that's how you consider the fact that the business itself will need to use some of its cash flows to pay those debts. And of course, if they use cash flow to pay debts, that's cash that's not coming to you directly. But also we need to consider the cash that the business has as well. So you want to subtract that from the market capitalization, because really it's kind of like buying a house that has a chest of $100,000 in the house that you get as well, that's buried in the house or something, right? You can subtract it from the price you're paying, because when you buy the property, you're also getting that cash. It's kind of like a discount on the property. So comparing the buy price of the business to enterprise value is how you take into consideration the cash that the business has on its books, and also the debts that it owes when you are investing in that company. And I just realized that I probably haven't spoken about enterprise value that much on this channel, if ever. So if that's something you're interested in hearing more about, I can definitely dedicate a video to talking about enterprise value and how it is different to market capitalization and why it makes more sense. So if you're interested in that, make sure you let me know down in the comment section below. But otherwise, that is all we had time for today. And I apologize if I couldn't get to your question this month, but hopefully I can next month. So leave your questions down below this video. But also, if you want the best chance for your question to be in next month's video, then what you need to do is you need to be subscribed, hit that red subscribe button, hit the notification bell so you get notified when I make the post asking for questions, and then leave your question on that post, which I will be making probably in about 4 weeks time, 4 or 5 weeks time. But if you enjoyed today's video, leave a like, hit subscribe if you want to see more content like this. But other than that, I hope you guys have a great day, and I'll see you in the next video.